It's my pleasure to introduce our first keynote speaker of the day and also the 2018 winner of the Energy Intelligence Petroleum Executive of the Year Award. Bob Dudley has been at the helm of BP since 2010, tasked initially with helping the company navigate the legal, financial and political challenges that ensued from the Deepwater Horizon tragedy. On Bob's watch, BP has dealt responsibly with the associated legal liabilities from that event. He's negotiated a new relationship in Russia with Rosneft, overseen a major asset divestment program, a third of the company, as Bob explained to us last night, and a comprehensive overhaul of strategy. The result today is that we're beginning to see the emergence of a new BP, a company that's bulking up again in US shale and developing plans for the energy transition, investing in clean energy, battery charging, and making a return to solar. So to hear more about how the new BP is taking shape and its views on the future of energy, please join me in welcoming the 2018 Petroleum Executive of the Year and the Chief Executive of BP, Bob Dudley.
Well, thank you very much, Jim. And good morning, everyone. And thank you for that very kind introduction. By coincidence, I started working in oil and gas the same year as the first Oil and Money Conference, which was 1979. That's nearly 40 years ago. So we've both been a bit busy since then. It is great to come here this year and see a lot of familiar faces, including many previous recipients of the award, and I'm very honored to join them. Thank you, Energy Intelligence, for the humbling recognition. Looking back to 1979, we have come a long way. People have said it, yes, and you said it last year. The fear used to be, of course, peak oil supply. When would we run out? How would the world cope with it when it happened? And people are now more concerned about, of course, peak oil demand, which is the pace of the energy transition and the very pressing need to bring carbon emissions down. That's going to require dramatic changes for society and our industry. It was made even clearer this week in the latest report from the Intergovernmental Panel on Climate Change. They're now calling for emissions to be nearly halved by 2030. That's around a decade earlier than the IEA's Sustainable Development Scenario. But by whatever timeline, we recognize the need for urgency on emissions. At the same time, we also recognize the global energy demand likely to rise by about a third. That's the dual challenge, providing more energy while dramatically reducing emissions. So as we confront that challenge, I think we are standing at a fork in the road, and we need to decide which way to go. That's what I would like to talk with you about today. We could go the way of people who want to drive a wedge between the energy industry and investors, between oil and money, if you like. They push for potentially confusing disclosures and raise the specter of systemic risk to the financial system from stranded assets and campaign for divestment, all in an effort to squeeze out oil and gas from the fuel mix. Most are driven by good intentions, but my concern is that their suggested recommendations could lead to bad outcomes, particularly for some of the most vulnerable people in the world. Or we could take a different path, more innovative and collaborative path, one that recognizes many fuels must play a part in meeting the dual challenge, albeit made much cleaner, better, and kinder to the planet. As I said on this stage last year, a race to renewables is not enough to meet the Paris goals on its own. And those that say the only answer is renewables are misleading. Instead, we must be in a race to lower emissions by all means possible. So faced with that stark choice, you can probably guess which path I think we should take. We must pursue the second one, where energy providers, investors, governments, NGOs, and everyday citizens are still working together to advance a low-carbon future. Let me start by examining what I see as the consequences of the divestment path. The first problem is it ignores the continuing contribution needed from oil and gas in this low-carbon energy transition. Renewables are growing at a remarkably fast rate, faster than any fuel in history, with optimistic projections, including our own, suggesting that they could supply around a third of the energy mix by 2040. But we still need to meet the remaining two-thirds of the demand, and oil and gas have a crucial role to play. They can do that and be consistent with the Paris goals, so long as carbon capture and storage is deployed widely, especially in the power sector, and as well as attention on carbon sinks, the natural cycle of carbon. Our BP Energy Outlook suggests a projection of 40% oil and gas in 2040. A similar IEA scenario puts the figure at almost 50%. In the models for a scenario meeting the Paris goals, growth in renewables should be able to meet the additional 30% growth or so in demand for energy. But BP economists estimate that many trillions of dollars of investment in oil and gas will still be required to counter the substantial decline rates of existing fields. Critics speculate that the assets of the international oil companies would have to be written off at scale if the energy transition happens faster or differently than those models anticipate. That will harm individual investors and the wider economy. I think those concerns are overstated. And to explain why, I think it's worth considering our recent history as an industry. Around $2 trillion of value was wiped off the oil and gas industry's books in the first 6 months after oil prices dropped and collapsed in 2014 into 2015. Now, that caused significant pain and difficulties for many parts of our industry. Here in the UK, 60,000 jobs were lost in 2016 alone. Those are real people suffering real consequences, and the numbers are vast across the globe. But in terms of the global economy and financial stability, the oil price collapse had a very limited impact. Yes, the oil and gas sector valuations dipped, and some individual companies took a real hit. But as a broader industry, we emerged leaner, more disciplined, and ultimately stronger. In fact, we're now even better positioned to weather a future downturn than we were previously. As far as the risks of investment decisions go, I believe the more serious systemic risk comes from underinvestment in the oil and gas exploration and production, not overinvestment. Suppose $2 trillion less were invested than actually required to meet demand. The impact of such underinvestment on financial stability could be much more far-reaching. Oil and gas supply would be constrained and prices would likely rise, slowing global economic growth with knock-on effects across all sectors. This could have serious economic consequences for both financial stability and economic prosperity more generally. I would also contend that there will always be someone willing to produce that energy. If it's not private companies, then perhaps others less focused on the energy transition will do it. Now, having said that, we need to continue investing in oil and gas. It is important to note that we certainly don't plan to develop it at all. The world currently sits on top of at least 5 trillion barrels of technically recoverable oil and gas resources. That's more than the world will ever need. And without CCUS, it is far more than would be consistent with the Paris goals. But even in a scenario consistent with Paris, where the percentage of oil and gas in the fuel mix is lower than today, the world will still need substantial amounts of oil and gas in absolute terms. Perhaps around 10% fewer barrels of oil in 2040 than today, at the same levels or a little higher of natural gas. In that competitive environment, the winning barrels will be the most economic to produce, the least risky to bring to the market, and the cleanest form of emission standpoint. That's what we would call advantaged oil. So we need to continue investing, not to find and produce as much as we can, but to access the most advantaged new barrels that will be needed to make up for declines. So if we progress a little bit further down the divestment path, Jim, if I might, there's another stumbling block. It's the so-called stranded assets argument. But this misunderstands the way our industry actually operates. Take the supermajors' balance sheets together. They have around $1 trillion of capital employed right now. And in any one year, invest about $100 billion. So very roughly speaking, that's enough flexibility in our portfolios to reshape our businesses and turn over the entire balance sheet in around a decade, which does provide flexibility and resilience for the future. Even though we expect and hope the pace of the transition will pick up, and it certainly needs to, it's likely that it will be measured in decades rather than years. That does leave time for the world to anticipate, and companies to anticipate changing trends, and companies to adjust their portfolios accordingly, including with many new forms of energy, including renewables, just as we're all doing now. There's another argument along the divestment road that doesn't hold, and it relates to calls for increasingly, my view, unhelpful, detailed, prescriptive scenario planning and disclosures. We believe in smart scenario planning and reasonable disclosures. After all, our license to operate depends on the trust of society, governments, and investors. And trust is built on a high degree of transparency. That's why our strategy already considers, and we disclose a range of plausible scenarios, including a pathway consistent with 2 degrees, about how the energy landscape might change and how markets could react with different assumptions about policy, technology, and consumer behavior. But what concerns me is the expectation that we should undertake a different kind of scenario analysis that tries to predict and disclose precise potential financial impacts on our business. To my mind, that sort of analysis needs to assume a particular future portfolio and assumptions on energy prices decades from now, which none of us is in a position to do. So you have to ask, is this kind of scenario testing even feasible? Could we disclose the results without releasing commercially confidential information? And crucially, is it even really useful for investors? I think the answer to each of these questions is actually no. While you may get precise scenario results, they will almost certainly be wrong, just plain wrong. And they will change every year. And they will actually confuse our investors. It would be the kind of equivalent of a stress test for oil and gas companies like the banks go through. It would, not to mention, impair our ability to adjust to the new world. And don't even get me started on what a gift this would be to class action lawyers. Really. So the case for that first divestment path doesn't withstand scrutiny to me, and more significantly, it focuses only on the emissions half of the dual challenge, and not on how we provide billions of people with more energy of all kinds. Let's consider what happens if we take the other path of innovation and collaboration. And let me be clear, this is not a call for business as usual. It requires significant and rapid disruption to our industry. We all recognize the energy mix has to evolve quickly, and we're investing accordingly. All of us know we have to help renewables push coal out of the power sector, I think. That's why we're all investing in all kinds of renewable energy, solar, wind, bioenergy, battery technology, and enabling electrification of vehicles. These are opportunities, not threats. It's also why we're investing a lot in natural gas. It emits half of the carbon emissions of coal and power, and is the perfect partner for intermittent renewables. And we're working in ways that were unthinkable when I joined the industry. When I joined the industry, one of the worst things you could do is find natural gas. So the industry has changed. So take the Oil and Gas Climate Initiative, a partnership of 13 companies that represent about 30% of the world's oil and gas production. Through the OGCI, we're working to develop CCUS, methane detection, monitoring, reduction, so that oil and gas can play their full part in the energy transition. And OGCI members recently set a 0.2% methane intensity ambition. That's an industry first to help gas reach its potentials. As an industry, we're also working together to expand carbon pricing. Not everybody agrees with that, but I think a well-designed carbon price or tax is something that helps incentivize everyone, energy producers and consumers alike, to play their part in reducing emissions. And through the Carbon Leadership Council, for example, we're supporting efforts to introduce a carbon tax in the United States. And collaboration, of course, is key when it comes to improving energy efficiency, something the IEA says could make the biggest contribution to meeting the Paris goals. We forget about that, just using less energy, as well as improving the efficiency of our own operations and products. We're increasingly working across the industry, not as just individual companies. For instance, by working together with automobile manufacturers, we're improving engine design, manufacturing, advanced fuels and lubricants, all of which could make cars in the EU become 70% more efficient than they are today, driving further on less fuel with fewer emissions. Today, when you drive around London, you use about 5 liters to drive 100 kilometers around London. 20 years ago, it was 7 liters, and we think by 2030, it'll probably be down as low as 2 liters to drive 100 kilometers in London, for example. So the second path sees us embracing change, coming together to meet the dual challenge. And we can do this even faster and more efficiently, I think, with clearer, smarter policy signals from governments. Now to conclude, Jim, looking ahead, we know there will be lots of challenges. Some we can't anticipate, some we can, but none is unsurmountable. Like many of you here today, I'm an engineer by training, and we're by nature problem solvers. So when I consider the enormity of the dual challenge, I'm not daunted by it. I'm confident our industry can continue to help power the world, lift people out of poverty, keep society advancing, while at the same time contribute to dramatically reducing emissions to meet the Paris goals. So long as we choose the path of working together in collaboration and innovation over the path of division and exclusion, trying to pick winners today on fuels, I think both our industry and the world have a great future ahead. Thank you.
Okay, thank you for that, Bob. So you're not too keen on class action lawyers then? Maybe I won't ask about them.
Not that I've ever met any. You were here, raise your hand.
You mentioned, there's one thing I wanted to pick up on, you mentioned towards the end there about clear policy signals from government. The industry is making some interesting strides, some commendable strides, through organisations such as the OGCI, which you mentioned. Government policy, I mean, if you look at the US, that seems to be moving in a slightly different direction. Do you think that's the right direction?
Well, I think so let me just contrast two countries in terms of emission levels. So regardless of what statements are being made, greenhouse gas emissions in the United States are now down to 1990 levels and continuing to fall. That's primarily because of the low cost of natural gas. So it's been driven by economics, and you're getting the right answer. The UK has put a price on carbon, and emission levels in the UK are down to Victorian times. So the last number I saw was at 1894 levels, and that's being done by policy. So they're being done in different ways, economics, some are policy. So there are lots of ways to get there.
So what's been happening in the US, some of the sort of...
On carbon pricing, you were...
Well, I was just going to ask about the sort of easing of certain regulations in areas like methane emissions, this kind of thing, because that's obviously moving in a different direction to some of the targets that we heard from Ben Van Beurden yesterday, Michelle, the OGCI. Is that sending the right message, do you think?
It's not changing anything big companies are doing, and many of the smaller companies. It's good business to avoid leaks of natural gas. So it's not changing what we're doing. And this is a wave of technology that will come into methane monitoring detection in the U.S. It'll be satellites, drones, infrared cameras. We're on the beginning, like in many industries, these huge technology changes. So it will be just good business and natural to bring all this in. It'll transform what's happening in terms of methane leakage in the U.S., I'm sure, and around the world. Carbon pricing, there is work going on in the United States on carbon tax, put a price on it. The design of it is really interesting. We'll see if this actually happens. It seems like it could work with both political parties in the U.S. and nothing else I think can today. But you have a tax on carbon for producers and consumers, and then the population gets a rebate at the end of the year. And I think everybody likes that. It'll be a separate check, apparently, maybe signed by the president. He'd like that. But there's a concept that would be quite revolutionary if it can come together. There's a lot of work being done on it in the U.S.
Okay. We had this IPCC report you mentioned out at the start of this week, which did paint a fairly bleak picture of where we're heading unless we take faster action, go further than people have maybe thought about before. Is your assessment that was fundamentally a little bit alarmist, or was this a kind of jolt to action that we kind of needed in politics?
I think that push and the stark reality we have to change is a good thing. I haven't read the details of what they've announced, but clearly it's a call to action. And I think not only oil and gas companies, but you need that in agriculture, you need that in steel production, you need that in the use of people pushing the button on the wall to get their electricity. We need to use forests and carbon and agricultural sinks differently. So that I don't think is only about oil and gas and coal. It's about everything.
And the objectives they spell out, do you think they are realistic, or is this going to be just impossible in the real world?
Well, I think just like I mentioned, I think it's really hard to say what's realistic today. Technologies will roll in, there'll be changes in this. I think it's not going to be a straight line to the projections that some are saying. I think emissions will go like this after a period of glide, because we're still bringing in lots of people, lots of populations. 1 billion people on the planet do not have access to electricity today. And there'll be 2 billion more people on the planet by the middle of the century. So all these are factors, and no one knows the answer yet. I do think, and again, I have many friends in the coal industry, but the epicenter, I think, of emissions is one coal-fired power plant being built a week in about 8 countries in Asia. To me, that's the epicenter of what needs to change, which is why I really believe in natural gas combined with renewables. And I think government policy should help make that happen, including multilateral funding agencies who have sort of turned off loans to countries on what they call all fossil fuels. And I don't like the term fossil fuel because it's natural gas, it's oil, it's coal. And I think there should be more enablement of the cleanest fuel of gas. So if anybody can help with that, thank you.
If we can just look at what your own kind of strategy, your own investments and plans towards the energy transition. You've been doing quite a lot of deals recently, LightSource and StoreDot and FreeWire. Mm-hmm. Is this at this stage, is this just experimentation to get a sense of what might work, or do you already have a kind of clear strategy of where you want to place BP?
Well, we had, at one point, the 3rd largest solar company in the world. We're very large in biofuels and wind. And then we had our tragic accident in the Gulf. We maintained the wind business and biofuels. Now we're back in solar, not manufacturing the panels, but doing project development. So what Jim is talking about is we bought about 43% of the UK's largest solar development company a year ago. Very good at what they do, focusing on Europe and the US, and we've now taken that company and developing projects with them in Egypt, in Oman, in India at large scale. We'll keep going throughout our operations. So you can take, it's a good example, you take solar, you develop it, even in the gas fields that you produce the power for what you're doing, and then you can put the gas molecules down the pipeline and sell it as a fuel. And it's a good balance with natural gas, so that's part of it. But we're not sure to where to make the really big bets yet. Mm-hmm. So we're investing a lot this way. People involved, small interest in companies, putting people on boards, trying to make sure. Because I've said this before to our investors, if you gave at least BP $10 billion tomorrow and said invested in the new low carbon energies, we wouldn't know how to do it to give a reasonable return to the investors yet. So strategically, get our balance sheet strong, and then when we know that, we'll be able to invest in those. So now it's learn, do a lot and learn.
Now, is this the role that the big oil companies are going to have in the energy transition? It's going to be a strong balance sheet and they're fundamentally going to be investors, or are there other skill sets you're going to bring to the party?
We'll bring a lot of technology, research, and science. I mean, that's what the companies have great capability in across the board. Won't do everything. Some things won't be natural to do, but there will be unbelievable technologies developed, from I think solving the methane leakage problems all the way through fundamental research. I mean, all the companies are involved and sometimes partnering. The solar, the wind, biofuels. Some are getting into electric power generation. We're doing a lot of power trading. I think BP is the largest carbon trader in the world today. All of these things are going to be essential in it. And I do think that instead of oil and gas companies, we'll probably be an energy company on a broad scale.
Big energy rather than big oil.
And we do big projects. I mean, that's one thing our industry does well, although we went through that period where we kind of overspent at the beginning of the decade. Quite famous for that, I think, with investors. But I think this downturn has made us be much more efficient with capital and investing and cost. And there's few industries around the world that can do big cross-border projects the way the oil and gas industry does.
Well, let's talk about oil and oil prices for a minute. You mentioned overspending. I mean, we're above $80 now. That's clearly good news for oil companies on one level. But what risks does that pose? Does that create a chance that we're going to go back to old habits? There's going to be cost inflation? Because surely the contractors are going to start looking for a bit more money if they see you guys earning more money.
Well, I think what you're saying in another way is, are we now off to the races again with spending? My sense of the industry, it learned such a painful lesson. Capital discipline is really important. Our valuation as an industry is still low because people worry we're off to the races and we're going to be spending too much money. So we're very disciplined, our company, really disciplined with our capital spending, and we will continue to be, and not plan on an $80 future. We're planning on a cycle, 60, 65. That's a bit up from the 55 I said last year. So I think we're a bit off the fairway on an oil price today that's good for the world. I think something more closer to a middle of cycle is good for the world, and I think we have to do that as companies. And the cost structures have come down. So the service companies, I don't think it's a world of, okay, now we shift the rent to the service companies. I think the companies need to work together to say, okay, what is it we do that drives your costs up? Let's work together, partner, and retool how we work. And that the new technologies are coming in and are massively changing the number of people working in our industry, like many others. So I don't think it's that kind of cycle again. I think it's a fundamental change.
Okay. I want to open it up to questions from the floor, but just one last thing I'd like to ask is just about the sort of geopolitical atmosphere the industry is working in, BP's working in at the moment. There do seem to be a wider range of complexities out there. There's trade wars. There's possible, there's going to be a tightening of sanctions on Iran, Russia. Relations with the West not exactly in a good place at the moment. How does that affect BP? What challenges is this creating for you?
It reminds me actually of the year I joined the industry, 1979. It was a very similar time where everything looked impossibly complicated. So I think we have to navigate it very carefully. Be careful not to take sides in politics, really, and be energy providers. We have a portfolio that's around the world, and some of it may get into some difficulties, but the portfolio is resilient enough not to depend on one place or anything. But we also have to realize, as Raj and I were talking about last night, our responsibilities are vast for working with the resources of nations and partnering with national oil companies all over the world. And we have to be not short-term about that or overly react to a political situation and think very long-term. And I think the international oil companies are good at that. I mean, I think it's not just contracts and transactions. It's about thinking, we invest sometimes 10, 20 years out. And I think it's not a problem. I mean, problems may happen, but it doesn't scare, I think, any of the oil companies.
Okay. Let's open this up to questions from the floor. There's microphones around. If you have a question, you can just give your name and affiliation when the microphone reaches you.
It's early.
Everyone's feeling a bit shy.
I thought it was going to come in early.
Oh, okay, hang on. We have in fact somebody.
Good morning, Jay Eden from Energy Intelligence. Sorry for the first question, which may be a difficult one, but carbon capture and storage. You're no longer actively involved in projects, even though you do put some money into research and development. Do you think for oil and gas majors promoting gas-fired generation, that you should be putting more money into actual commercial projects, or should it be utilities that are doing it, or do you think it should get some kind of government financing like renewables have had? Thank you.
I do think if carbon capture and storage or use and storage had some government supportive subsidies over the last 10 years, we'd be much further along with that. So I think there's a missed opportunity. The UK is doing a lot now on exactly that. We and some other companies are working on the possibility of a combined power generation, clean power, and then injection into deep formations in the North Sea of CO2. That has some promise, and you may see us doing that. We were involved in 4 big carbon capture and storage projects. We're still involved in one, sort of the tail end in Algeria, but they were not economic, and the industry has experience of getting right up to the edge and doing this. Happened to BP, happened to Shell, I think a year or so, where the government pulled back at the last minute and the project didn't go forward. It needs some of that. But it'll be more than just those kinds of projects. Believe it or not, the new regulation in the United States called Q45 has the most incentives in the world for CCUS, and we'll see. So that's suddenly a surprising area. You hear about policy and regulation, but there's one that's quite dramatic change. And I think CCUS is not, it all sounds very complicated. Some people say, what is that again? Carbon capture, use and storage, or utilization and storage. It's a little bit like recycling of a carbon atom, like we do and should do with plastic. If you just think about what we were trying to do with CCS, it's recycling the carbon atom. And I think it does need government incentives, but there's things like the OGCI is working on, investing heavily in a company that makes cement. Now, cement is one of the biggest CO2 emitters, carbon emitters, in the world. But this company has developed a process that actually absorbs CO2, and it's cheaper than conventional cement. So just getting things like that mandated out there by governments and our own procurement processes can do something nobody's thought about. So the CCUS has got a wide range of potential, but it needs some help. And we actually need to explain what it is, because people actually say, well, what are you talking about? So this idea of recycling the carbon atom, a circular economy of carbon, is probably the best way to think about it. It's a long answer to your question, but...
Okay. We've got time for one more question. Gentleman at the front here.
Thank you, Bob. Congratulations again for your winning the award.
Thank you very much.
Your former colleagues in China asked me to congratulate you. They sent me WeChat messages now.
Thank you.
So congratulations. And you did excellent work in the BP operation in China before. My question is about BP's equity stake in Rosneft. Is there concern that the US sanctions against Russia will sooner or later reach the BP's equity stake in Rosneft, or are you assured that exemptions can continue to be obtained? And what is the overall plan for the Rosneft equity stake for BP? Thank you very much, sir.
Great. So my legal team would say, don't answer that question. But,
Please do.
Yeah, but I will. They also know I will. So one thing, I'm not sure about anything. You said sure, so I can say I'm not sure about anything. But I think I'm on the board of Rosneft with another person from BP. I work really carefully to make sure our work and what I do is always within the bounds of the sanctions. I'm very transparent about it. talk to U.S. government officials about it. It's a financial investment. I don't think that would happen. I think if I'll make an observation: if sanctions were put on Rosneft or Gazprom or Lukoil, like what happened with Rusal, you would virtually shut down the energy systems of Europe. So that's kind of a bit extreme thing to happen. We invest in Russia carefully, not just the investment in Rosneft, and it's a serious company. We work with them, working with them on environmental, greenhouse gas emissions, safety, and with their professionals. So very happy with that investment, but we'll be really careful.
Okay, I think we're about out of time, so please join me in thanking our Petroleum Executive of the Year, Bob Dudley, for joining us this morning.